Tell us about the Open Opportunity Fund. Right now, we've seen a period of time where diverse companies are not getting a lot of VC funding. What's your goal right now, and what is your focus?
Absolutely. Look, Blacks represent 12% of the U.S. population. Latinos, another 18%. So combined, 30% of the U.S. population, but they only receive 3% of venture capital funding. Right? It's off by an order of magnitude. And that gap means about $40 billion a year that's not going to these founders. Our view is there's great returns in alpha hiding in that overlooked population. And Opportunity Fund is about how do we find exceptional founders and companies and fund them and go find returns that others are overlooking. And it's working. The fund is delivering top quartile returns by investing in these founders.
I want to talk about AI for a minute. Emerging tech, it looks like it's going to transform so many industries. You have 14 companies in your portfolio that have direct exposure to using AI. I think someone may even call them AI companies. How important is diversity as we see AI develop?
It's important on how you train data. It's important on how you cleanse that data. Do you have the right sampling of the world when you're making decisions about facial recognition or what natural language means? But then also we have diverse founders that are just using AI to solve really interesting, hard problems. For example, CityBlock is delivering healthcare to overlooked and underserved communities. And they're using AI to actually look at medical notes and figure out what conditions are present in those patients. And so using AI to solve just different problems, whether it be companies like Flutterflow, it's two ex-Google engineers, Black founders that are figuring out you can just describe what website you want to build, and the AI will write the code for you and give you something that's ready to click and just go to the cloud.
Really? Interesting. So I want to give you all your credit. You're a founder yourself. You also were part of the management team of a company that IPO'd, Barracuda Networks, back in 2013. Have you ever seen anything like what we're seeing when it comes to NVIDIA's GPU chips? So we had a CNBC story recently that said there's some startups that are actually going into debt to acquire those chips. You support, you guide your companies. What are you telling them about these chips? What are they telling you about acquiring these chips to power their AI features?
Yeah, we see this oftentimes when there's new infrastructure. We saw this with blockchain, and there wasn't enough nodes, and it led to companies like QuickNode that we invested in. We saw this in the early days of cloud. But what happens is there's not enough capacity. If you think about the large cloud providers, Amazon and Microsoft and Google, they have to service their big Fortune 1000 companies and customers. And startups often can't get enough capacity,
right,
or they're looking to be more efficient. If you're training a large language model or you're training a specialized vertical stack, that could be millions of dollars of your startup funding. So you're looking for access, but you're also looking for efficient costs, and it's led to companies that have specialized GPU stacks to give that onboarding.
So is there a way around this, or do you just have to go to NVIDIA right now and pay up? Because we've had analysts come on here and say NVIDIA has about 90% of the AI chip market.
They have a really strong lead. Like, they were early in deciding to repurpose their GPUs, right, as we know, and I mean others are trying to catch up. I mean ARM is doing work there, right? We know this IPO is coming up, and they have this market share in the smartphones, but they have chips that will be useful both at the edge for AI as well as within a data center.
Okay.
But for the next couple of years, I think that NVIDIA is going to really enjoy this lead that they have.
So you got to pay to play, basically. That's what you're saying. So you invest in companies. I want to talk to you something about valuation. It's been a theme this whole year. So I want to really focus on the hyperscalers that have, direct business with a lot of your portfolio companies. Let's talk Amazon, Microsoft, and Alphabet. Amazon, 62 times forward earnings. Microsoft, 30. Alphabet, 23. Is this valuation as stretched as some people make it out to be, or in your mind, because you know how important these services are for tech companies, they seem more appropriate?
Look, I think those three, those big cloud providers, look at the revenue for the cloud. They're doing between, $30 to $70 billion a year, each of those cloud services, and it's not slowing down. Their large enterprise customers are still moving infrastructure to the cloud. Those cloud businesses alone, I think over the next few years, will represent the full market cap we're seeing of those companies right now, the $1 to $2 trillion market cap. And then you get almost for free kind of their traditional business, right? In Microsoft, the Office applications, and Amazon retail. And so I think we will see those companies continue to grow into those valuations.